Jabari. At IBA, we want to engage in various discussion with key policy makers from State Bank of Pakistan and Ministry of Finance and various other policy institutions in Pakistan to discuss various things related to the economy of Pakistan. What is the current situation? What are the bottlenecks, and how can we move forward? So this is a sort of that webinar where we invited lead policymaker from State Bank of Pakistan to present the key insights from SBP annual report recently published by State Bank of Pakistan. And we invited the director, economic policy review department from SBP, and he's going to present key findings of that report. And we also invited discussions from academia and from the industry, so that let's engage with academic discussions where what are the key viewpoints and how policymakers actually currently thinking, and what are the viewpoints from the academia. So let's try to engage in this way. So over to you, Rabia. So Rabia is going to moderate this session. Rabia, over to you.
Thank you so much, Dr. Adnan. Thank you all the respected speakers for joining us today. So today we will have first of all presentation from respected Dr. Umar Farooq Saqib, and then we will have discussants, and then I'll open the floor for question and answers. So firstly, we are fortunate to have Dr. Umar Farooq Saqib Sahab with us, who is currently the Director of Economic Policy and Review Department and has served State Bank of Pakistan in various capacities. He was also the Director of Monetary Policy Department and has served in National Institute of Banking and Finance as its Director for Academics. Dr. Umar Farooq is also the founding editor of SBP Research Bulletin. Prior to joining the State Bank of Pakistan, Dr. Umar was associated with academia and research institutes in Pakistan, Germany, Finland, and Cyprus. I request Dr. Umar to please share his thoughts with us.
Thank you very much, Rabia and Dr. Adnan. And I'm very thankful to the management of IBA to actually invite me to share these insights of our recent annual report and what we are thinking, and as just Dr. Adnan has described, what are our views on our economy. So, I mean, Pakistan's economy, there is one thing that is pretty common in Pakistan economy that keeps repeating itself, which is a sort of hardy perennial, which is one can easily say is the balance of payments crisis, which off and on strike Pakistan economy. So I'm not going to take you a very long time back, but let's go back to 2008, and we saw that the oil price shock, when the oil price actually had risen close to $150 per barrel, there was a huge and gigantic BOP crisis in Pakistan. So as a consequence of that particular crisis, there was an inflationary explosion, and basically Pakistan economy was locked in a vicious equilibrium of high inflation and low growth. And as we have seen that BOP crisis and oil price shock was not the only thing. Unfortunately, in those days, the terrorism activities were at their peak, and Pakistan economy was really paying for its price, along with very strong challenges coming from the energy sector. So what we actually saw that Pakistan in the post-BOP crisis 2008 experienced one of its longest spells of double-digit inflation. Previously, it was in the post 1970s oil price shock that Pakistan experienced double-digit inflation. I mean, inflation remained in double digits for 5 long years, actually. And of course, economy was not growing. Private sector credit was recording negative growth, unfortunately, in those times. So things were not really good. And but later on, we entered an IMF program, and as a result of good policies, and I would also say a bit of a providence in those times, we had a very favorable, this time a very favorable shock of oil price, which helped actually change quite a bit of a landscape. I mean, of course, I would say that there were policies uh, in action before this favorable oil price shock. But what actually this favorable shock did to Pakistan economy, that for example, when inflation was sliding into single digit in levels, because of this particular shock, the decline in inflation became all the more spectacular. And then we saw that Pakistan economy started to grow, and many people had remarked in those, especially 2 years, that now Pakistan is back in the now this time a virtuous equilibrium of low inflation and high growth. And of course, there was a successful IMF program that concluded. But I think, as you might have guessed by now, that as the Pakistan's economy starts growing and improving, usually what happens that twin deficits start to emerge, and this is something that once again started to happen. That not only the twin deficits started to emerge, inflation also started to rear its ugly head in those times. So basically, ever since FY18 and FY19, the policy makers started to tow with the stabilization measures. And if you recall, State Bank of Pakistan, of course, is a pretty forward-looking. I mean, when it makes its monetary policy or something like that, as you might know, that we focus on the future, especially in the next 12 months. In the medium terms, we rely on quite a bit of a forecast. And then after a lot of rigorous thinking and research, we actually undertake a policy decision that you actually see after every 2 months. So since it's a forward-looking thing, so we were seeing that imbalances in the economy are actually emerging, and as a matter of preemptive sort of measure, we started to adjust the exchange rate. If you recall, there was quite a bit of an adjustment in Pakistan's exchange rate, and the policy rate, which was very low in those times, started to climb. But the imbalances were also ballooning gradually. So what actually happened in FY20 in the beginning, we again entered an IMF program, the International Monetary Extended Fund Facility Program, for 3 years. And so we embarked upon a stabilization policies ever since the beginning of FY21. So what we actually did, so as you can see in the slide, that there were basically, what I would like to say, three measures that we focused on. They were fiscal measures, monetary measures, and external measures. So in fiscal measures, what we did actually, that we reversed multiple tax concessions. If you recall that mobile top-ups were exempted from withholding tax, so that was, for example, reversed. Salaried class people were also given concessions previously. That was also reversed. And actually, in the elimination of concessionary tax regime, we did see that there was a zero tax regime in for example, textiles, that was eliminated, and in some other sectors. So these measures were taken as far as but at the same time, from the expenditure side, a lot of hammer was given on the development expenditures. So they were very much restrained, rationalized, so to say. And of course, there were some efforts at the documentation of the economy. And if you recall that for high value purchases, it was made mandatory to show your CNIC. And of course, there was one amnesty scheme also. So there were efforts as far as the documentation of the economy from the fiscal side that also took place. As far as the monetary measures are concerned, the last time we jacked up the policy rate, that was in July 2019 by 100 basis points, and actually it was a very high policy rate at 13.25, and we kept that policy rate during the most of fiscal year 20. Since we were also in the IMF program, so there was a complete elimination of government borrowing from the central bank. So actually, ever since then, there is a zero borrowing from the central bank, and the government has actually adhered to this particular measure. And there was enhanced communication as far as the monetary policy is concerned. We have been very aggressively tackling with the key stakeholders, market analysts. So even after every monetary policy decision, we sit down and explain, and we take, make a lot of effort to explain to these key stakeholders and market participants that why this such a decision has been taken. So communication, of course, or publication of the monetary policy statement was already there, and not only the monetary policy statement, we have been publishing the minutes of the monetary policy committee as well. So, and we further enhance it with meeting with the key stakeholders as well. So these measures from the monetary side were taken. And as far as the external sector is concerned, that that there has been a historic transition to a market-based exchange rate system in FY20. Actually, towards the end of May, to be very precise, we had made this move, but it really was manifested in this particular year of FY20, and to this date, this is going on. So, so the adjustment actually now are going to reflect both ways, what is happening in the foreign exchange market as far as the supply and demand. This is what they are going to reflect. And since we are in the stabilization mode, so there were some regulatory duties also, regulatory efforts were also put into place in order to curb the non-essential imports. And also there were some measures already in place. For example, the LC margin of the State Bank of Pakistan, that was actually already in place since 2017. And in the beginning of 2019, we actually enhanced those particular measures. Pakistan remittances initiative is a very popular initiative in Pakistan. It has been there, but during this particular time, we further enhanced this thing so that we can have more workers' remittances flowing into Pakistan through formal channels. So broadly speaking, these were the policies. And what I would like you to focus here is that there are 2 points that one should be focusing here. First, as the many students of IBA would appreciate, that these were all demand compression policies. So the challenge was to contain the twin deficits, that is current account deficit and the budget deficit. This was the objective, and also to curb the rising inflationary menace. So these are all demand compression policies. But the highlight, what I would like to emphasize here, was that there were some structural policies that were also were a part of this particular package, and these were actually transition to market-based exchange rate system and zero government borrowing from the central bank. Now, in addition to this, I would also like to say that government has concerted efforts in order to rein in the particular respect. They have been undertaking quite a few. For example, NEPRA Act was in process to be passed, and some other, maybe we are going to discuss later on, those things that were trying to do. So a demand compression policy package, along with emphasis on correcting the long-standing sort of structural issues as well. So that is what happened in the beginning of FY20. So as we progressed along these stabilization measures, let's focus on the external sector first. So now, as you can see that in the left-hand side, trends in current account balance and non-energy imports and exchange rate. Now you see that we have this real effective exchange rate also in the left hand side panel. I mean, it's an inverted scale, so when it goes down, this means there's depreciation. And on the right hand side, we have nominal exchange rate, which was also adjusted to reflect what was going in the market. So ever since I would say August 2019, the non-energy current account balance was actually in surplus because of these policies. So you were curbing non-essential imports, and this was actually paying you in the shape of this surplus in the current account. And on the right hand side, you can see how this thing was happening. You will see that in FY20, in July, February, this is FY20 from July till February. It's not the whole year that we're talking about here. So you have nearly all these import items witnessing a negative growth. And this is not only actually real effective exchange rate or adjustments in nominal exchange rate. This is also because that we had a very tight monetary policy in place as well. Your policy rate was 13.25%, and also your fiscal policy was also tight as far as the rationalization or restraint of your development expenditures is concerned. So all these taken together, these policies started to give its output. Now, if you go on and see the growth in exports, I mean, of course, it's a textbook prediction that you adjust your exchange rate and your exports are going to. Now here, what I'm trying to show you here that this data is about the volumes and exports and not the export receipts as per in dollars terms, right? So there are some other reasons that why that thing was a bit restrained. But as far as the volumes are concerned, you see a great improvement in this particular. If you see all these categories, for example, cotton yarn, home textiles, especially, and then this basmati rice, all these volumes were increased during this particular period in July, February. And ever reliant workers' remittances to Pakistan, you will just see that these are the growth rates, not in dollars. So you see that only from the corridor of USA and UK, there was some negative growth, but rest all of them had a very positive growth in July, February period. So overall, there was a growth of 5.6% in this part of the fiscal year of 20. Now, having said that, I would also like to say that owing to this, although I don't have the chart to show you, but there was a fact that we were moved to market-based exchange rate system, and the policy rate was also very high. So we have seen, and there was an improvement in the fundamentals in Pakistan. So we also saw a surge of financial portfolio investments in Pakistan also. That was also phenomenal in that particular time. In addition to some encouraging trends in the foreign direct investments as well. I wouldn't say that they were very high, but the trend was encouraging. And since we were under the IMF program, so we also received the first tranche of that extended fund facility. And with good progress, the multilateral inflows were also encouraging. So what actually happened that first and foremost, with the improvement in the current account deficit, your foreign exchange reserves actually started to follow an upward trajectory. So in particular, what I would like you to focus on is that the forward liabilities in the Pakistan case, as you can see, they were really decreasing. So this is something very good. Actually, in this particular period of July till February, there has been an unwinding of 5.2 billion US dollars. And in the same period in July, February, on average per month, there has been an improvement of $1.3 billion in the foreign exchange reserves. So the external sector was, I mean, leading from the front and showing improvement and showing actually basically the results of the policies that the Pakistani authorities had implemented. So moving on to the fiscal indicators were also very encouraging. As you can see, that both the primary balance actually was in surplus in the first, if you take the first 3 quarters of the fiscal year 20, although you see a small deficit in the third quarter, but it is basically because in the month of March we were struck with the COVID-19 virus. So towards the last month of second quarter, we see a slight primary balance deficit in our. Otherwise, if you take the first 3 quarters of this FY20, your primary balance was in surplus. And there was a consistent improvement. There was also improvement in the revenue balance. I mean, many of the students would appreciate that revenue balance is the revenue minus the current expenditure, right? So this actually shows that for your current expenditures, your revenues are fulfilling. So this is a very important indicator of the government, of the fiscal, that if you are actually, you are not borrowing actually for your current expenditures also. So this is a kind of a good equilibrium indication as far as the fiscal indicators are concerned. And of course, you know that primary balance is fiscal balances minus the interest payment. So that is also something that you are not financing your development expenditure with the help of that. So these fiscal indicators were, so what is more interesting as far as the fiscal indicators is concerned, that the FBR tax collection, that was something really remarkable. If you to focus on the left hand panel of this diagram, you see that FBR taxes during FY20, that is the green line that you see, right, in FY20 only, and the line which is below that, that is FBR's 5-year average. So in FY20 alone, because of the policies that I just singled out in the beginning of this presentation, that made a lot of difference. And of course, I would say that there was economic activity as well. And similarly, the SBP profits were also really above the, 10 years average, quite above the 10 years average. There were some revaluation gains as far as the SBP profits are concerned. So that is why it gave. So what I'm saying, that external sector was showing a very good picture. So our objective of reining in the twin deficit was actually giving results, and quite encouraging results, and all that policy. Having said that, this might not be the case with inflation. So as I'm sharing with you that the national CPI inflation was on an elevated level. I mean, 10% in January 20 is quite high. This is a year-on-year growth. So basically, what we have seen there, that economy, was absorbing the impact of exchange rate depreciations that were undertaken before, and there was the taxation measures of the budget FY20 that I just shared with you a while ago, and there was some increased fuel and transportation costs during the year. So actually, the economy was absorbing this thing, and this was being reflected also in the second round impact in the national CPI. But mostly, what was pulling this this national CPI trend was the food inflation, as you can see from this particular graph. But having said that, the non-food, non-energy, I mean, the measure that actually helps you understand the underlying inflationary pressures, that were somehow stabilized. I mean, the trend, it had no trend. So if you look at the urban and the rural dynamics, you will find out that the light blue color is the non-food, non-energy, right? And now if you look at the Q1, Q2, and Q3, you don't find any trend in the non-food, non-energy. So you see, although it is on a high level, so somewhat it is stabilized. So your core inflation, and now this is actually showing you that the inflation expectations were well anchored. And because of the very prudent monetary stance of the central bank, that you were seeing very well stable underlying inflationary pressures. So what is going high is because of the food inflation. And why that is going high and why that is pulling up, I mean, there are many structural bottlenecks. What I would like to encourage you people that you please go to the SBP's website. And last year, no, this year actually, in March, we had published a staff note on this particular phenomena, on the structural reasons of high food inflation in Pakistan. I encourage you to read that, and you will understand quite a few dynamics or quite a few reasons that why this has sort of becoming a recurring sort of phenomena in Pakistan. The shocks from and how we do not have shock absorbers, so as to say, in our economy, that when a shock hits the economy, why we are not able to accommodate that shock properly, and then it is reflected in high food inflation, for example, so to say. So well, the bottom line is this, that the external sector was improving very encouragingly. The fiscal indicators were showing very healthy signs, but the inflation, as the whole national CPI is concerned, that was on an elevated level, but the underlying inflationary pressures were somehow stabilized. So this was the story of July, February, that this is how this was going on. Now, it was precisely at this time that the economy was stuck with the COVID-19, which necessitated social distancing and lockdowns that you people are now very much familiar with. So this is taken directly from the Google. You can see that there is a sharp decline in retail and recreation, grocery and pharmacy, going to parks, transit stations, workplaces, only your residential is intact. So this is actually showing the extent of the COVID-19 shock and the results that the economy like Pakistan had faced. So as a result, I mean, we have seen that economic, industrial manufacturing, and that was really heavily impacted during the lockdowns. Now, as you can see, the agriculture was not that much affected. Actually, many people claim that agriculture remained unscathed. I mean, it remained unscathed. I mean, nothing happened to the agriculture sector. But maybe later on, I will discuss that how COVID-19 has also impacted the agriculture later on towards the end of my presentation. So you see manufacturing growth, it was a projection. These projections are from the ministry, as they always do in the beginning of the year. And you see the outcome, that how the actual performance has been of this particular year. Similarly, I mean, if you go a little more deeper, you see that export growth, how it was doing in July, February, and how it performed in March, June. Similarly, LSM index performance in July, February, and then March, June, and change in SBP's liquid foreign exchange reserves, that also, you know, sort of we lost a few of the reserves, and the fiscal deficit also not very much, but slightly that was higher. Now, as a result, now you people are very much familiar with this, that the whole economy contracted by 0.4%, and this was our first brush with negative GDP growth in a span of 68 years. So after 68 years, Pakistan economy contracted by 0.4. So such was the severity of this shock, that an economy such as Pakistan, with a high population growth rate, which has never experienced negative GDP growth, it also experienced a negative GDP growth after a span of 68 years. Now, you see all that policy things, the progress, you know, it actually, everything went totally upside down, you see. But Pakistan economy, we have argued in this annual report as well, was very well positioned to actually cope with this particular shock. I mean, I have said about 2 or 3 times in my presentation so far that we had a market-based exchange rate system. So it acted as a great shock absorber as well. We have actually still a zero borrowing from the central bank, very and we were having actually a primary balance surplus when this COVID-19 shock struck the economy. So and also as I said that non-food, non-energy, the underlying inflationary pressures were very well anchored because of our policy rate. Policy rate was 13.25%. We did not spend a lot on development, and we had rationalized the expenditures in the better most of FY20, and there was enhancement in the Pakistan remittances initiatives. So all these policies that were going on that actually put Pakistan in a pretty good situation to actually cope with this particular shock. So as a result, what we saw that if we only see at the SBP's response, so there was loan deferrals and restructuring, support for exporters, Rozgar scheme, support to healthcare sector, loans for investments, not only for new investments but for BMR activity as well. And above all, there was a policy rate reduction of 625 basis points. So it came down from 13.25% to nearly 7%. And it is still there. And all these policies actually we have tried to quantify the impact of these policies as well. And we see that, for example, the loan deferrals and restructuring was 657 billion. And by the way, this has also supported the financial sector stability also. So that thing is also very much there. Support for exporters, restructured loans, rupees 280 billion, Rozgar scheme 238, for healthcare 8.4 billion, loans for investments 238 billion. So the pickup in loan for investments was a bit late, but it is now very much there. So this is the latest situation that I'm sharing with you. And not only that the central bank had embarked upon this particular package, also the government had also announced a nearly 1.2 trillion rupees package in which they supported the wheat procurement, the labors, for allocation for vulnerable families, electricity, gas and bill relief, deferred interest payments for SMEs, etc., etc. So you see all these earlier strong policy stances were very instrumental in facilitating this sort of huge response when this crisis struck the Pakistan economy. Now what we see that, and there is one thing more, that despite this COVID-19 shock and everything, you will find out that the external, there was not much of a problem in the external sector still. The current account was still very in a sustainable position. And though your fiscal deficit was slightly higher, but it was still less than the fiscal year 19 fiscal deficit. So you see the shock was, I mean, the twin deficits that we were trying to correct, they were not really shaken as a result of this particular crisis. And reason that our policy stance in the beginning was pretty prudent, and that actually was giving the result. So when we enter the fiscal year 21, and now I think we are towards the close of the second quarter of fiscal year 21, we see that the economy has actually responded very well. I mean, when the lockdowns were lifted towards the middle of this particular first quarter of fiscal year 21, so what actually happened that the economic activities was very much restrained. So once you lift the lockdowns, the economic agents and everybody found themselves in a very accommodative policy environment. So before the COVID-19 struck, the focus of the policies was, as I said earlier, demand compression. So we had the policies, we had the COVID-19 shock, we provided so much support, and there was a lockdown. And as the lockdown is lifted, now you find that policy rate is not 13.25%, it's actually 7%. And the government is actually focusing on growth. Uh, and uh, and this pent up activities because of this lockdown, they were also allowed to come into action. So you see a very a great vibrancy as far as the economic activities is concerned. So just to share with you some high frequency demand indicators, you see this is the fast moving consumer good sales, how it has climbed. So in the fourth quarter and now look in the first quarter, 18%. You look at the local cement dispatches, so that has gone more than 15%. And it's an all-time high cement dispatches sales, by the way, just to share with you. And petroleum sales, as the economic activity has resumed, the petroleum sales have also come up. Power generation with economic activity has come up. And most importantly, the car sales. I mean, the industry which was really suffering because of these demand compression policies that we had, actually that has also, I mean, of course, it is slightly more than 0% growth. I mean, it is, but I mean, they have remained in a negative territory for a very long time. So this is something also encouraging that the economic activity is actually coming to our this pre-COVID trajectory that we were experiencing. And now, what is remarkable in this particular thing? Remarkable thing is this, that as I told you in the beginning, that when the economic activity starts to take place, usually our current account deficit starts deteriorating, fiscal deficit starts deteriorating. But if you look at the first quarter data, you see that both these current account and the primary balance, they are in surplus. So this is something I would say remarkable, of course, very important and remarkable as well, that nothing has happened to these two indicators. So that is actually showing a positive, very positive recovery indicator in this particular scenario. And you people are, I think, familiar, the IBS students also, the business confidence index, that is actually has surpassed the 50, the benchmark. So the expected business confidence, so the public is pretty much buoyant now about the future of the. So far so good. I mean, of course, we had a difficult time, but here I also would like to say that not only because of the policies of the central bank, I mean, the government also had good policies as far as the lockdowns are concerned. So their lockdown policies have also, I mean, how they have arrested the spread of COVID-19 in Pakistan. And I'm talking about the first wave. I'm not talking about the second wave. Of course, the second wave is there. And it is causing a great deal of uncertainty as far as the economic activities is concerned. But so far, the indicators are not actually reflecting that. So maybe after, when the data for second quarter is available in January, we will be in a better position to understand that how the economy has coped with the second wave of this particular menace. This was about the annual report or what has been going on in the very recent past. And since the second part of this presentation pertains to the way forward, so I thought maybe I will share some few things about going forward, and then of course we can go to the panelists. So way forward actually is about structural issues, basically. I mean, of course, we have not into distant past. I mean, the IMF program that we had previously, we were pretty successfully, we did that program, and there were improvements in the economy. But even just after 2 years of this program, the economy started to face these particular problems again. So what should be done? I mean, there are many structural issues that the Pakistani economy needs to take care of. So this is this is the way forward, and this is what we have argued also in our report. I mean, for example, uh, nothing can replace the foreign exchange which is earned through the exports, right? So we have to focus on exports, and time and again, if you are familiar with our reports, even with our monetary policy statements, we have been emphasizing on this a lot. So I mean, as a student of economics, we all know that exports is a function of structural and cyclical factors. So cyclical factors are beyond the scope of us. I mean, the demand, the demand of the rest of the world, what's going on, it is beyond, I mean, as a very small open economy, it is beyond the scope of our economy, Pakistan. But there are structural issues that we have to focus. I mean, we have seen in the COVID-19 crisis that the economies of Southeast Asia have fared pretty well compared to the Western economies, I mean, USA or European Union, etc. So maybe it's time to diversify the markets. Maybe it's time to look for the new markets. So market diversification is a structural issue that we need to focus. Product diversification is something that we need to focus. And of course, so far, we have actually taken care of one very difficult structural issue, that is the market-based exchange rate system. Now we have a market-based exchange rate system. This is something that was really lacking in Pakistan, and going forward, hopefully this particular policy is going to carry on. So exports is something that we need to focus. I mean, as they say, everybody and his aunt knows that tax base remains narrow and excessively vulnerable. And we have seen, and if I mean, everybody knows this thing. Even in the first quarter, when you are going to look at the tax figures in first quarter, you will see that with the resumption of economic activities, the taxes have rebounded also. So it's very cyclical in nature, so very pro-cyclical. So we have to do something about that. Documentation, informality, this is something that needs to be pricing and governance problems in the power sector. I had hinted towards it a little bit in the beginning. So that thing is also very much there. Actually, in the beginning of FY20, the government did have a plan for reduction in circular, and they were coming with the NEPRA Act as well. And but still there are many needed things in this particular sector. For example, the governance of discos is something that needs to be, lot needs to be done about that. And upgradation of transmission and distribution infrastructure, that is also a very big problem that is facing. More recently, although I have not mentioned it here, progress on FATF is also crucial as far as the foreign investors are concerned, and we have made quite a few strides. I mean, we did qualify 21 out of the 27, the benchmarks that were given to us, and the remaining one were also partially covered. So encouraging progress is there as well. And the other thing that we have argued in this particular report is the improvement in the country's financing landscape. So this is something that really needs to be done something about. And in relation to this, we have actually, if you are familiar with the reports of State Bank, the annual and quarterly reports, so you will see that in each issue, we come up with some special issue, special section or a special sector, chapter, some thematic analysis of emerging issues, some structural issues. So we have a number of them. We have been covering ICT exports. We have focused on power sector also. We have focused on exports, etc., etc. Quite a few topics we have covered. So in this particular report also, we focused on this financing thing, and more we try to understand the low private credit penetration in Pakistan. So this has been something in detail we have dealt with, and very quickly I would like to share some of its findings with you people. I mean, you know that this is the situation of Pakistan's private sector credit when you compare it vis-a-vis the rest of the world. So if you just focus on the left hand side, and focus on Pakistan and two other countries, Nepal and Turkey. So in the year 91 to 2000, you see that Nepal and Turkey are below Pakistan, and in the slot of 2001 and 2010, Both these countries, I mean, as a percent of GDP, 37% is Nepal and 24% is Turkey. Now coming very close to where Pakistan is. But in the last slot, you see 2011 to 2018, you see Pakistan is now 17%, but Turkey is 59%, and Nepal is 13%. So this is something, which needs to be focused. And not only this thing, if you look at the right hand panel, you see the percent of firms with a bank loan or credit line, where Pakistan stands here in emerging and development economies. I mean, the comparison is this, and percent of firms that used banks to finance working capital. And that also Pakistan is somewhere in the bottom, and proportion of investments financed by banks. And here also Pakistan is towards the bottom. So credit penetration is missing in Pakistan, really. So you expect investments and private consumption to really grow, you need to have a good credit penetration. I mean, very quickly, there has been not been a, the reasons, I mean, we have highlighted is we have tried to evolve. I mean, we have looked at the evolution in Pakistan. And first and foremost, you see that your left-hand side gives you a very interesting scenario, actually. So what do you see here? That you see the financial institutions efficiency among emerging and development market economies, and financial institution access. Now, as far as the financial institution efficiency is concerned, Pakistan rank is not so bad. It's at 43. But when it comes to financial institution access, so it is 127. It's very poor. Now, if you recall, many of you might have read the history of Pakistan, and not to about a couple of decades ago, we used to have specialized institutions for credit, right? Now, when we embarked upon the privatization of banks in 1990s and 2000s, our focus was, shifted somehow towards the implementation of Basel Accords and financial sector stability. So the emphasis somehow was shifted towards that, and in the process, the deliberate push to lending and this thing that somehow went in the bottom, so to say. So as a result, now you see that, of course, yes, financial institution efficiency, Pakistan has remained largely unscared in many global financial crises, which is partly thanks to our very good financial sector assessment. But in the process, we have, I mean, and this shows also in the right hand side that adult population and access, that is financial access, is very low. Another thing is this, that there have been some information asymmetries. That has also been the reason. And if you can see, as you see here in this particular figure, that Pakistan is also a very low as far as the public credit registry coverage is concerned, and the credit to GDP ratio. So you can see the dots which are up, where there is, as a percent of adults, public credit, I mean, credit bureaus, you informed you about the risk profile of the individuals or the companies, etc. So that has been missing in Pakistan, and something that is really, and especially this credit registry thing is also very important when we talk about promoting micro and small medium enterprises, right? So in that particular context, it is a very important thing. But when we come to the housing finance, is also something we are lacking in Pakistan. With high credit penetration is the mortgage financing in many of the countries, as you can see from here. And of course, the foreclosure laws implementation, although there have been foreclosure laws in Pakistan, we had a certain act, but their implementation has been a problem. For example, people could go to the courts and take the stay out of it. So that thing actually has been addressed recently. So the recent reforms in the current context, that has been very encouraging. Recent reforms have actually aimed at affordable housing finance, tackling information asymmetries, and digitization of financial services. So in affordable housing finance, you see that many reforms have been taken as far as the land entitlement, registration, and digitization is concerned. So, for example, if you are going to some patwar khana in Punjab and you are trying to get a FIRT issue, so they will now do it quite quickly. I mean, the number of days in order to get that FIRT, that has been actually increased. And property registration process from 7 days previously, it has now come down to 4 days. So these land entitlement, these laws are very encouraging. And you have heard a lot about the Naya Pakistan housing project. SBP has very low cost housing finance available for that. And mandatory targets we have given the commercial banks for this particular achievement. And construction industry in the form of tax exemptions, etc. They have also been incentivized when it was given the status of industry as well. And the legal system, I mean, I was talking to you about the FIRO Act of 2016, Financial Institutions Recovery of Finance. That is what it's called. So there is a new and improved Section 50 as far as the implementation of this particular in foreclosures is concerned. So that is a very welcome move. So housing finance has taken a quite a central role in order to, and that we hope going forward is going to enhance this credit penetration. And as far as the addressing the information asymmetries is concerned, so State Bank of Pakistan has already issued guidelines and licensing criteria for credit bureaus, and actually in July of 2020, licenses have been granted to two firms, that is Data Check and AIS. And secure transaction registry has also been established, which this is something really significant, because now, especially in the context of small and medium enterprises, micro, small and medium enterprises, so movable assets can now be used as collateral. So that is something very important, very encouraging development. So going forward, this is, we have argued that how to increase the credit penetration in Pakistan. And since we were having this COVID-19 and the ensuing social distancing and lockdowns, so we also focused on a small section in the COVID-19 and need to boost digital connectivity in Pakistan. So this is also a special section that we have compiled. And as you can see that tele density, we have just given an overview about the tele density in Pakistan, how it has improved. I mean, in March 2020, it was 81.2% compared to 62.4% in June 2015. And broadband penetration is also 39.1% as of March 20. And during the COVID-19 lockdown, you do see that the search interest as far as the online shopping, food delivery, and groceries is concerned, that actually has followed what was going on in the rest of the world in Pakistan also. However, I mean, these are the things that you see on the surface that is going on in Pakistan, but the thing that actually also these crises have brought to the forefront is that there has been a very strong there is a digital divide in Pakistan also. I mean, this is something also that one needs to. So to make it more inclusive and sustainable, we see that Pakistan, where Pakistan stands and in terms of mobile internet penetration is concerned. And Pakistan, while it has high usage and coverage, it has high usage and coverage gaps. So for example, if you look at the bar of Pakistan, so 54% has access to mobile broadband coverage, right? This 54%, but only 26% subscribes to usage bundle. So penetration is very low. And 20% have no mobile internet service. So this is the situation. And the gender gap is huge. I mean, I don't have to say anything. This figure is actually very loud and clear, describing you that how this gender gap is there in as far as the mobile phone and internet penetration is concerned in Pakistan. And also Pakistan ranks the lowest in South Asian internet inclusiveness. So the policy prescriptions that we have noted in this particular special section is, of course, upgrade the digital infrastructure, education on digital services. Perhaps many people still don't, considerable perhaps proportion of population still do not appreciate the use of this particular facility. And the government must act, because this thing might not happen on its own. The government has to take certain incentives to encourage digital payments in the market, and overall orientation of the economy should be tilted towards digitization of the services, and it's digitization, as to say. So this is, I mean, a few things that I wanted to say uh, of what is the situation right now. So the situation is really that we have this balance of payments problems in Pakistan. They are a recurring phenomena, or and we have been coping with that. What policy measures we have taken in the recent past, we have seen the encouraging thing of this particular stabilization episode is that there are some good structural reforms that we are focusing on. So that is something encouraging. And hopefully these structural issues that we have identified in this annual report, by mentioning them and also tackling them in a bit of a detail in our special chapter and special section, so that remains to be seen that how the Pakistan economy actually performs on that particular front. So with this, this is what I wanted to just say, and I'm now look forward to the comments of the discussants and the questions if there are. Thank you.
Thank you so much, Dr. Omar. Thank you so much for your valuable insights from SBP's report, annual report. Before, I know a lot of participants have questions, but before going towards participants, I would request our honorable discussants to give their comments one by one. And I would request this if you can keep your comments in 10 to 15 minutes. First up, our first discussant is Dr. Ahmed Jamal Pirzada. Dr. Pirzada is a faculty member at University of Bristol, UK. He very actively shares his views on social media and Twitter, and he has a lot of following there. And we look forward to hearing from you, sir. Please, over to you.
Thank you. Can you hear me?
Yes, sir, we can hear you.
Yes, and you can see the slides as well.
Perfect.
Perfect. All right. So right. So first of all, thank you, Rabia and Dr. Adnan, for giving me the platform to share my views, and thank you, Dr. Umar, for sharing an excellent presentation. So I think Dr. Umar has already told us in quite a lot of detail on what the crisis looked like and how the central bank has responded to it. And if you ask me about my views, I think the central bank has responded in a very good way, both to the crisis and also to the COVID shock. In the few minutes I've got, what I want to focus on is rather what happened or what was happening before the crisis, how we ended up there, what was the role of monetary policy at that point in time, and what are the lessons we can draw moving forward in light of that discussion. I think let me skip that. This has already been done in an excellent way by Dr. Omar. And let me straight away move on to this. So I think I'm sure many of you have been following the literature on macro finance after the 2008 financial crisis, the global financial crisis. And one thing which has come out of it, so one thing which has clearly come out of it is essentially the role the credit plays in predicting the financial crisis. So if you check the papers by Oscar Jorda, by Ellen Taylor, and these guys, it's very obvious over there that financial or credit bubbles are a very strong predictor of a financial crisis. And if you look at total credit for Pakistan, which is what we have got over here, we see a very similar picture here as well. Nothing special going on, nothing out of the blue, which you couldn't have predicted. So what I'm plotting over here is actually total credit. It's in real terms. And this is deviation from the trend. And what I want you to focus on is essentially that just before the crisis here in 2018, you can clearly see that there was this credit bubble building up. And then as predicted by the literature, it obviously ended up in a crisis. Right? And the question we want to ask is, what was behind this credit bubble? Okay. So here's the next figure. So the red bars over here, they are the same as the figure before. It's total credit to both the private and the government sector. And the green bars actually represent the credit uptake by the government sector. And you can clearly see over here, almost all of the fluctuation in total credit uptake is actually driven by credit uptake by the government sector. Okay. And for those of you who have actually taught or studied international economics, the picture over here is very, very simple to an extent that it's actually boring. Why? Because what we have actually seen, you can clearly explain that as a first generation currency crisis. And in a first generation currency crisis, for those who don't know, what really happens is that the government borrows, spends, the central bank essentially keeps the exchange rate fixed. The way that they do that is essentially by running down on reserves or borrowing money from the international markets, and then again using that to support the exchange rate. You keep on doing that, exchange rate keeps on getting overvalued. Essentially comes a point where the reserves have fallen by enough that speculators go for it. And then the central bank just gives up defending the currency because there are not enough reserves left in the system. So in that sense, there's nothing really special happening. And then it can be very, very succinctly explained by this in the context of these first generation currency crisis models. But the question we then want to ask is, what was driving this behavior on part of the government? And here, what I'm plotting is the same figure, but then on top of that, what I'm plotting is the short-term interest rate, which is essentially set by the central bank. And this is essentially on the inverted scale. So the higher up you are here, the interest rate is the lowest. The lower you are here, the interest rate is the highest. And clearly you can see over here from the point onward, when the central bank started to ease the monetary policy, you can clearly see that there was an uptake in credit uptake in essentially coming from the government, right? And then the interest rate, they remain low for about 3 years or something like that. And then that's the point when you really see the credit bubble building up. And then you can see over here, then when the policy or when the outlook started to get worse, you can see essentially the credit bubble going bust. You might think that the credit bubble actually went bust because of the central bank increasing the interest rate. Partly, yes, but then not necessarily, because if you look at the long-term borrowing costs for the government, if you look at the PIB rates, what you end up seeing is that the PIB rates started to go up much before the central bank started to increase the interest rates. So maybe the market was anticipating that the crisis around the corner and inflation is about to rise because the exchange rate had started to adjust. And perhaps they were anticipating the central bank to start increasing the interest rates, but essentially the market was already predicting it. Right? And that sort of opens the question. It sort of opens the question, if I may say so, on the role of monetary policy with respect to preempting the crisis. Right? So where was the monetary policy at this point in time when the credit bubble was building up? Why couldn't the monetary policy preempt it? Did we really have to go through this bust over here? Did it make sense? In hindsight, if you think about this, households, are they better off now, given that this is all they have gone through? Given that the households are risk averse, I don't think they would have preferred the path the economy actually took. And they would have preferred a path in which the central bank could have intervened much sooner and stopped the bubble from building up, and then essentially stopped or avoided paying this cost in terms of a crisis, right? And that's a critical question we should be asking, especially going forward. So what are some of the possible explanations? Why didn't the central bank respond the way it should? Why couldn't it predict the financial crisis or the given that the credit bubble was already in the making for about 3 years? It wasn't something which you can only see in the hindsight. So there are possible explanations of that. One is obviously you can say it's fiscal dominance, that the central bank policies were actually dictated by the finance ministry. I think there is some truth to that, but then there are also two other explanations which we must keep in mind as well. So I think Dr. Umar rightly pointed out, and perhaps I think if I go back to him, this is probably what he'll say, that there were no inflationary pressures in the economy. So why should the central bank increase the interest rate, right? Let's downplay the output side for a while. And he is in a way right, because in a way, right. But then in a way, there was the prices or the inflation signals we were getting were actually distorted, right? And they were distorted both on the demand side and also on the supply side. So on the demand side, we had the exchange rate, which was fixed. So this overheating of the economy, which should have led to the depreciation in the exchange rate, which would have led to inflation, and then that would have translated into the central bank increasing the interest rate. That didn't happen. The government essentially shut off that channel. And likewise, on the supply side, the energy price increases, which are permanent in nature, in the case of Pakistan at least, they were not passed on. So essentially, that channel was also cut off, right? You might think, why should the central bank respond to the supply shocks? Well, sure, if the supply shocks are transitory, if they are not going to have any second round effects, then yes, the central bank shouldn't respond to them. But these are the permanent shocks we are talking about. These do have second round effects, and then the central bank should essentially care about this, right? How strongly, there's obviously a trade-off there with respect to output stability and inflation stability. So how aggressively should the central bank respond depend on the preferences of the society, the structure of the economy, and all those things. But essentially, there is a strong rationale for the central bank to actually respond to such shocks, which are permanent in nature, irrespective of whether they are supply shocks or demand shocks. So that's one. That's the second possible explanation, and we see some of this happening now as well. Like energy prices have not been passed on for the whole year, even though on the exchange rate side we are doing pretty well, which is a good news. The third more important thing, which is also quite relevant for the discussion in macro literature, is that perhaps there is a very weak link, or the link between the demand side and inflation has actually weakened over the last 2 decades. And there's a lot of evidence for that. And then essentially many people have actually written papers on this. I've also got a paper on this with my co-author, Engin Kara. But the literature is still debating why is that happening, right? So what are the structural reasons which are resulting into it? And it's important to understand, imagine if overheating does not result into inflation for its own reasons, nothing to do with what I've said before, then surely the central bank is not going to respond that much, and then essentially the bubble just gets going on its own. So what is driving this? So there's this paper I'm working on currently. It's still far from complete, but then I've got some initial results which I thought are worth sharing at this forum. And this is the first time I'm sharing these. So what I'm trying to study over here is essentially trying to understand what are those features of the economy which can give us this weak relationship between the demand side and inflation. Right? And then I want to ask the question, okay, so if we can replicate this, what does that mean for a monetary policy? So for those of you who know this literature, let me just quickly in a minute outline the structure of the model, and then I'll explain the results, which will be general enough. So the structure of the model, it's basically a multi-sector model. It's open economy, so you have imported inputs, you have imported consumption, it's incomplete markets. But then importantly, now there's heterogeneity in price stickiness. So you have sectors in which prices are completely flexible, like commodity sectors. And you have sectors in which prices are sticky, like services sector and so on. And then you have production networks. Okay, so industries, these sectors are not autonomous. They are sort of linked together, not just through relative prices, but also through production networks. And then you have supply shocks, you have demand shocks, and these are the shocks which I think are most important for emerging economies like Pakistan. And what do we find? The first thing which is very interesting, I think it's pretty cool, is as what you see over here in an open economy setup, you can see, okay, so in a closed economy setup, you see that the correlation between GDP, the demand side, and inflation is pretty high. Once you go towards a more open economy, that sort of weakens the relationship between the GDP and inflation. And then once you allow for these input linkages, the relationship weakens even further. Right? And this is over here, I've only got a 2-sector model because it's easy to calibrate for a country like Pakistan. I don't have enough micro data. But if you increase the number of sectors to 5 or 10, this correlation over here weakens even further. So the first thing which this model is able to replicate is, given these features, it can replicate that the relation, or why the relationship between the GDP or the demand side and inflation has actually weakened over the last 20 years or so, right? The next question I want to answer is, okay, fine, we can replicate the data to an extent, perhaps. What does that mean for monetary policy? So I ask a question, okay, so let's say the central bank is setting the interest rate according to a Taylor type rule, but then the central bank wants to minimize this loss function. Essentially, the society cares about stabilizing both inflation and also GDP, right? So think about that as unemployment, or if that makes more sense. And then I want to ask the question, okay, so how aggressively should the central bank respond to changes in output, to changes in inflation, to changes in the exchange rate? And the answer is very, you might think it's unintuitive, but it's very, very intuitive. I'll explain that. And the answer is, as the relationship between the demand side and inflation weakens, the central bank respond towards stabilizing inflation should actually be a lot more aggressive. And why is that? The reason for that is because, remember, so the central bank controls inflation through demand management, right? It's actually a demand side policy. And because the relationship between demand side and inflation is actually weaker, it's a very Keynesian economy. It's an economy where Phillips curve is very flat. So if you want to stabilize inflation, you really have to really react in an aggressive way so that you cause a large enough fluctuation in output, either on the upside or the downside, to stabilize inflation, right? So you can see over here, as far as the response for output is concerned, there's no surprise here. It sort of stays the same. There's no change in the answer. But for inflation, the response is pretty aggressive in this environment where the relationship is much weaker, where the Phillips curve is much flatter. And likewise for exchange rate. So you can see over here, the openness does not really matter much. But once you allow for these supply linkages, these supply chains, the production networks, whatever you want to call it, then again, the central bank should also be very much concerned about the volatility, not the level, the volatility in the exchange rate. And the idea is very much, I still need to explore this further, but I think the intuition will probably be that because you are importing these inputs, and then because you've got these production networks where firms are linked together with each other, so an input price shock, for example, or an exchange rate fluctuation can really amplify or the volatile, let me say it again. So volatile exchange rate can, through the supply chain, can really increase the volatility of inflation. And that essentially means if you are concerned about stabilizing inflation, then essentially you should respond in a much more aggressive manner. And this is obviously true both on the downside and on the upside. So let's say if inflation is below the target, then you should cut the interest rates much more than what you would otherwise to stimulate the economy by enough to bring inflation back to the target. And then likewise on the upside, if inflation is above the target, right? Okay, so this obviously raises the question, given what the 3 points we have discussed here. So this obviously, going forward, what does this mean? What this means is that can the central bank credibly commit that they will be able to preempt such a bubble in making in the future? Right? Another way you can frame the question is also, you can say, okay, so will the central bank, if you believe in the fiscal dominance type of story, will the central bank have enough autonomy or the leeway, right, to set the policy instruments in a way which help achieve this policy objective, which is essentially about minimizing business cycle fluctuations, right? Central bank is not concerned about the structural features of the economy, productivity, and all those things. Central bank is primarily responsible for minimizing business cycle fluctuations. And that's what really we are thinking about here. So will the central bank be able to do it or not, right? Because otherwise, if the central bank is not able to commit that they will be able to avoid such a bubble from emerging in the future, then essentially that's not sending a good sign to investors both at home and abroad. If the macro environment is going to be very uncertain, that sort of really takes the fun away from investing and all those things, right? So that's pretty obvious. To save time, let me skip the second point here. Let me also make sure, even though I'm raising these questions, we are still very far away from the bubble in making. We are just emerging from a crisis. So it's not the point, this is not the time to worry too much about a bubble emerging in the economy or multiple interest rates as such. But these are definitely things to watch out for in the future and to commit to the agents in the economy that this is something which is not going to happen in the future, right? Because otherwise, if you let it happen, essentially then what you're doing is you'll be hit by a crisis, and then in the crisis, you're sort of engaging in a pro-cyclical type of policy, which is very, very costly in terms of welfare analysis, right? And essentially, it's sort of a consequence of you not preempting the crisis, right? I mean, you didn't preempt the crisis happens, and then you have to do what you have to do, and then that's essentially a pro-cyclical type of a policy, right? And that's not really desirable. The last thing I want to make, the last point is essentially also to keep in mind is we are still very far away. Yes, reserves have improved, which is good. The central bank is doing a good job on that end, but still we are still very long way away from building adequate level of reserves. I mean, if you believe in the Greenspan rule, that essentially tells you should have enough reserves to cover your external liabilities over the next 1 year. But that's not really empirically relevant. If you look at the case, the empirically relevant case, which is for emerging economies, comes out of the Oxford paper as well. It turns out it has to be somewhere in excess of 20% of GDP, right? For China, for South Korea, for these emerging economies, it's essentially 26%. So let's say in excess of 20%, that's something which we should have in mind. For Pakistan, let me again, the caveat here is probably this is a bit too much for us. Why? Because the double drain scenario, which is considered in the Oxford paper, it relies on two things. One, that the emerging market or the domestic economy is very much integrated with the financial markets, international financial markets, which we are not, right? And the second thing which it relies on is essentially that the domestic banking system, even though, remember, credit, I didn't say that before, I should say that before, that the total credit which we were looking at, that's 70% of our broad money supply. So it's not something which is inconsequential, right? So it does matter a lot for aggregate demand. So it's not like, fine, credit bubble does not have an effect on the real economic activity. That's not correct, right? It's 70% of your aggregate demand. So if something happens to total credit, it does mean a lot for what's going to happen in the economy. So, but then again, even though it's 70%, it's still very, very low compared to, let's say, emerging economies where it's much higher, right? So both the channels, the first channel being our degree of integration with the international financial markets, which is pretty low, and then again the banking system, which is again not that big, not that big a proportion of the GDP as for other countries. So both of those channels are somewhat smaller. So perhaps 20% or excess of 20% is not really relevant for us at this point in time. So perhaps we should think of 20% as an upper limit and as a medium to long run objective. But that's something definitely we have to keep in mind, because remember, currency crises, they don't just happen. So the first generation currency crisis we considered here, that's very much our own doing. It's sort of shooting yourself in the foot. But then you can have currency crises which are not your own doing, right? So something goes wrong in, let's say, elsewhere in the region, and then market or everyone panics, and then essentially you have a crisis, right? The third generation currency crisis type of things. So you have to have adequate reserves, even if you're doing everything right as far as your policies are concerned, both monetary and fiscal. So you have to have adequate reserves to sort of make sure that you are not hit by a current, or you are sort of you have sort of insulated yourself from such a crisis emerging in the future. So with that, I'll pass it on. Thank you very much.
Thank you so much, Dr. Prizada. It was really a really nice presentation, and thank you for raising some really intriguing questions. Next up in our panel is a very famous name, Dr. Amir Zafar Durrani. Dr. Durrani is president at a private initiative, Re-Energia and Payadar Tabanai. He's also famous for his former affiliation with the World Bank. So I request Dr. Durrani to please enlighten us with your valuable comments.
Thank you very much. Assalamu alaikum, and good day to everybody, wherever they are. First and foremost, I'm not Dr. Durrani. I explained this to Adnan many times that I feel very flattered when you call me doctor, but at the same time, I feel very kind of I object to this title, because the thing is that I am, after all, an engineer who the World Bank turned into an economist over 18 years. If everybody forgets that up until the 80s, 64% of the bank's portfolio was essentially operational infrastructure lending. And so the World Bank was very famous fights between engineers and economists, because we look at economy in a very different way than what we call myopic economists. But I mean, with all due respect to them. So my take, and I think after listening to Ahmed Pirzada, and I always am overawed by his discourse. And thank you again, Dr. Umar, for your very elaborate presentation on this. I was lucky in March and April to be sitting with Dr. Saab, Hafiz Sheikh, and actually listening to Raza's prediction on the economy. And this is the COVID season, if you remember the pre-budget discussions, and whether it's going to be -2, -2.4, or -0.4, which it ended up being taken as a number. So I think I want to talk a little bit, after all these numbers and everything, as to what is happening to the private sector. And I'm going to give you an industrial perspective on this, more a private sector perspective on this. And some of the questions I have, I think, are more going to be questions than commentary. So I hope that, Adnan, you wouldn't mind that, because this is really, I'd like to take this opportunity of all you erudite and Illuminatis to basically answer some of our questions. First thing first, I think that the overall reading the State Bank report, even during the World Bank, I never read the entire State of Economy report, but this time I did. And I simply went through it and I found that it was overly laudatory. Now, I remember the tensions between finance and State Bank, and I'm taking you back to the years 2002, 4, 5. We always thought of the State Bank report as kind of a give it in your face kind of report, right? What is really reality? I think this report, first and foremost, for me, uh, is laudatory, but at the same time, it does touch on some very interesting issues. And the couple of issues that I am really hung up on is first is access to credit and credit uptake. And I think let me start with that, because I think that while we talk a lot about all the fiscal measures and the monetary measures that the state bank does, whether it be taxes or whether it be interest rates or actual financing of the government, in reality, Pakistan, if you take our stock market, or whether you look at how much credit uptake, it's a very thin slice of what really happens in Pakistan. And the issue is that how deep is our stock exchange? How deep is the impact on the everyday life? And I think the report itself answers, and it was very nice when they explained, that there is a problem when you look at credit uptake both by individuals and by industry. And I think this here is not just a question of information asymmetry, which very rightly they address through ratings and improving the ability to have these credit ratings and measures in place. But I think more so, and I want to ask this question, because we need to look at all this and also look at how Pakistanis save. So my question first question to the panel, to the State Bank, and maybe if any of the other panelists want to answer, is that really why don't we think about this whole because everybody has a different view. So I'm talking about really the investments and savings going into real estate and into gold basically. And we should come out with how is that impacting our economy, what needs to change, what are the measures on the basically the fiscal side. Are we taxing properly? Do we need an inheritance tax? Do we need more of a wealth tax approach? And that debate is not happening. So just simply crying that we have a narrow tax base, the credit uptake is low, to me, we need a little bit more holistic thinking. The second thing I think I want to get to is this whole thing about, and I think Pirzada very rightly said, if you think about it, that, we are on very shaky footings. The two things which I thought were intentionally avoided, although you did some nice sections on, again, on the digital side and also on the credit side, we should talk very openly about the pensions, and we should talk very openly about the power sector debt. Now, parking a power sector debt, which is basically a stock and flow problem, and basically issuing bonds, is a one-time relief, right? And I can guarantee you that if we fundamentally don't structurally address the issues in the energy sector, we are going to have this debt ballooning. Look at South Africa, the ESCOM's debt. They have almost every country has a power sector debt, which we, I think, infamously call circular. There is nothing circular about it. It's more a telescopic debt. But the point being, if we do not fundamentally revise our contracts and obligations in the sector, then we're going to see this power sector debt, energy sector debt. We're going to see all sorts of debt going down the line. And I think that is going to become very serious. Now, pensions, again, I think whether these are pensions relating to SOEs or the overall government pensions, I think they have been pinching us. We've been having a very flippant attitude of thinking that somehow government's going to be able to finance this growing. I think there is no real actuarial work that has taken place on this, which brings me to my third point, which is the government footprint. I think when we talk about, and I'm going to link this to very rightly, the forward-looking 4 points that the State Bank mentioned. The first is basically, and I'm going to pick on exports. I'm not going to talk with the revenue base right now. Let's take exports. Now, I think now I have fundamentally been in the industry for 35 years, but even before that, I still remember that even as a young person in the 70s in Lahore and St. Anthony's, we was talking the same thing. Let's diversify our exports. Let's do this. Let's do that. Our export basket hasn't changed. Now, what is really going on? And I like the state bank saying, okay, yeah, well, let's go and explore new markets, because obviously the COVID has impacted some of the growing economies less than the developed economies. Yes, for example, if you look at March and April, you were talking about basmati rice. If you look at where it went to Africa. It went to Africa because the Africans, anyhow. So that's a new market, right? But beyond rice, beyond a few tractors, beyond a few things, I think we are very poor at exploring and diversifying new markets. And this goes back to what I call a structural problem of our private sector. The structural problem in our private sector is essentially the inability to corporatize. And I think this is kind of I want to park it here, the inability to corporatize, because I think our private sector is worse than our government. And I've been saying this probably since 1998. If you look at some of my presentations on the trade side, that we often blame government for being inefficient at ports, but if you look at who is making the ports inefficient, it's the private sector who parks their goods without actually clearing them and using government property as basically a free warehouse. Now, that's a very specific example, but my point being that when you start talking about export diversification, I think it's time that you start also doing some work on how this export diversification is going to happen. Because, what Ahmed said very rightly, that in a linked economy, and when you have a backward forward linkage through your value chains, again, unfortunately, we are not even part of the global value chains to the extent that actually I think we can call ourselves a linked economy. Ahmed, I would like you to expand on that a little bit. I know you've often commented on what Gonzalo is talking about intermediaries, and I think cut duties on about 5,000 items this last year, and I have yet to see the impact of that, because traditionally, what is really happening is nothing on the export side. We said yes, we have highest exports in the last 10 years, but all that could be that we were the only ones, and we who were exporting at that time, simply because we were less COVID infected. I have basically two more quick points to make and maybe ask about. I think the whole thing is that we sort of start patting ourselves on the back, and this is something that came into the World Bank, and I think it's now come to the Pakistan government post Wolfenson. The whole thing when Wolfowitz came and everybody said we don't celebrate our success, and I think this is really now become a global phenomena. And I think maybe that's why the governor has made this report very laudatory. But I think for example, take remittances, right? Ali Khizr and I have talked often about what is really happening behind remittances. And you've seen my tweet on saying what I really see is happening in remittances is nothing to be shouting and writing home about. It's actually what is happening is now we have more organized money laundering happening. Because if you open up the construction sector and you close down the Hawala channels, this is what you're going to get, right? And this is why you're also seeing the kind of trends from both US and UK, because those remittances go to very different areas. Now, you cannot do that remittance calculation through banks and understand which area remittances goes to which region of Pakistan. And that explains why these remittances are going up. But I would have liked to read something about remittances, constructions, and FATF, anti-money laundering, and all that. So sort of knitting the story together, really explaining to the average citizen, why we are going through what we are going, because what if tomorrow, and the reason why, again, say we need to be very clear on these linkages is because if we are not clear, then we are always open to sudden shocks. And I think the second last thing, is government footprint. I think we keep talking about this and that, but from markets, support prices to direct wheat procurement to whatever, I think what this is doing, there are two problems here. The first one, I think we need to start talking about very openly as the people who talk about economy, is that really I don't want lesser government footprint because of just wanting lesser government footprint. I want it for two reasons. The first is sometimes because the government is in this game too much, it gets blamed too much for things, right? I mean, this food price thing, I would have liked to see, Ahmed and Dr. Umar, some discussion about a global food price. The global food price surge, if you are reading, what people are writing around the world, is there. So while we are simply blaming all, for example, wheat on hoarding and all this, it's nothing new. This has been happening. So what is the above average factor that's taking place? Let me on wheat give you two posits. The first is the World Bank gave a $68 million loan to Afghan government to back up their wheat reserves. So if you stop focusing just on Pakistan, you start looking at the region, you will start seeing that wheat buying spike by Afghanistan. So guess, we are neighboring. Kazakhstan is another one of the 7 largest exporters of wheat. So guess what's happening in this region? Pakistan's wheat, and this was borne out in late October. I rode out to Torkham, and 5-kilometer line of wheat grain going and leaving Pakistan, right? So these are trucks just waiting there to go into Afghanistan. Now, my point here being that number one, government should simply pull out of all types of these support mechanisms and in food, right? On wheat, setting prices. This should go into the private sector, and you'll see what massive difference that makes. The second part on this is the government footprint in basically these state-owned enterprises, just by and large, government is everywhere, and government is lying idle. I have an office here on Park Lane, and I think we haven't talked about that all from the National Agricultural Research Center all the way to where our university is, the ComSats and all, you will find that you have acres of land where government entities are sitting on. It's not being turned into active capital. So I think the government footprint for those two reasons: one, inefficiencies and thwarting competition, because this also links, by the way, to the export dilemma, right? Because what we have basically done is we created a private sector that lives off of this big government, right? Whether it be subsidies, whether it be rents, whether it be duty drawbacks, etc. And last, I think I would like to hear about something which no one has talked about, and the report doesn't talk, is the rebasing of the economy. This is something that was already under consideration when the report was being printed. Why hasn't this been brought out? Because as you know, you've seen a growing automotive sector. The government's discussion around rebasing the GDP is basically based on, is based on just, new entrants in the automobile sector, 4 or 7 of them. And then also, I think we have to finally untangle why and how to account for this, what we call the digital GDP. So I think on those two things, again, I will end my inputs. And I'm sorry if I posed more questions than actually a commentary, but thank you for the time, Adnan, and it's always a pleasure. Thank you, Rabia.
Thank you so much, sir, for sharing your views and actually raising some really interesting questions. And apologies for using your wrong title. So next up, we have in the panel Dr. Khadija Malik Bari, who is a really famous academician and well-established. She is also a faculty member at Institute of Business Administration, Karachi, and she has been a former head of Department of Economics. She often shares her views in newspaper articles as well. So we really look forward to hearing from you, ma'am. Please.
Right. Thank you, Rabia. Thank you, Adnan, for inviting me. It was a very interesting discussion and presentation. Dr. Omar pointed out few things, and I hope that during my input, I would be able to somehow comment on some of the points that Dr. Durrani has, or Mr. Durrani has raised. Dr. Umar points out about in his report about the increase in the volume of exports because of the stabilization policies that have been adopted by the government. For example, the market-based exchange rate and the relief packages, timely relief packages given to sectors like textile industry. And then Dr. Umar rightly pointed out that there are structural and cyclical issues regarding the increase in the exports. My focus here is on the first primary question as to how we understand what competitiveness is, because in various forums I have read and heard that Pakistan is very competitive in the textile industry. How do we see competitiveness? The way competitiveness is used by policymakers or industrialists seem to point out towards the fact that increasing exports is a sign of competitiveness. And here, when you have a continuous devaluation or the recent devaluation that we have seen, plus concessionary access to EU markets, plus other external factors like US, China trade tension, that has led to the increase or some stability, some cushion that has been provided to our export sector. But does that truly mean competitiveness? Does it imply that Pakistan has become competitive in this sector? Time and again, relief packages have been given to our export sector. And as Mr. Durrani pointed out, that he has, we have been talking about product diversification for years. But these relief packages tend to reinforce cost focus, make industries sluggish, and make them less effective in terms of bringing efficiency within themselves. And either these competitiveness is far more holistic in the sense that it should push the industry to move towards higher value-added products. It should push the industry towards better productivity, skill development, and these things have been lacking in even the most competitive, so-called most competitive sectors in Pakistan's economy. 60, 70 years of experience in the textile side. What textile institute of national repute do we have today? Like, where we tend to say that 60% of our export earnings tend to come from the textile side. Do we have any single, let alone international, a local institute of some repute that is producing skilled human resource for our so-called most competitive sector? Why is it that our industry has failed in spite of continuous relief packages and incentives given by the government to come out of its commodity mode? We are still stuck in the commodity producing products and highly sensitive to international factors. Why has the industry failed to move towards higher value-added products? Why are we not producing relevant human resource? We talk about export sector, we talk about the structural impediments, we talk about the relief given by the government to the export sector, but either that relief has to be linked with some mechanism that pushes the industry to move towards higher value-added products. But what I feel is that the way these relief packages have been working in the past, they have been just reinforcing the sluggish attitude within the industry, an easy way out for the industry. And I mean, even in terms of product diversification, even in terms of market diversification, we do not see any effort or consolidated effort between the ministry, the government, and academia, even the top business schools in Pakistan. What specific courses with the leading export sector of Pakistan are these top business schools conducting? We do not have any specialized courses for the export textile sector of Pakistan that constitutes 60% of our exports. So I feel very strongly that there has to be a consensus in understanding what the term competitiveness means across the industry and the policymakers. And competitiveness is not purely increasing the exports because of a weak currency or low labor cost. So the relief packages and the other incentives have to be linked with some mechanism that would develop the relevant skill in the sectors that the country identifies as its competitive sectors. And then a holistic approach to competitiveness needs to be adopted if we have to answer the questions, some of the questions that Mr. Durrani raised, as to why we are still talking about product diversification. How can we go towards value addition if our academia, if our industry is not even looking for higher or better skilled human resource in those sectors? So this is, these are the questions that came to my mind when Dr. Umar Saqib was presenting his report and Dr. Durrani was raising some very interesting questions. That's all from my side, Dr. Na.
Thank you so much, Dr. Khadija. Before going towards the participants, I would request Dr. Umar if he would like to comment or answer any of the questions.
Yes, I can. If yeah, should I carry on? Can you hear me?
Yes, sir.
Yes, okay. So I think very interesting questions raised by both Dr. Khadija and Amit Rani. I think let me focus on one question, and I think that sort of links up with everything else as well, or to most of what everything else as well. And that's the question which Amit Durrani raised with regards to, so there's a decrease in tariffs, but then nothing really interesting happens as far as exports are concerned. And that's very true. I think that really hits at the core of the problem. And this is not just recent. If you go back, and I do have quite an issue with this tariff liberalization thing in the absence of markets working properly. If you go back to end 90s, we probably decreased our tariffs more than anyone else in South Asia, right? And nothing really happened. The most of 2000s is actually marked by a decreasing export to GDP ratio. Exports, they did increase in dollar terms, in value terms, but then as far as the allocation or the structure of the economy is concerned, nothing really interesting happened there. It wasn't that all of a sudden the economy was allocating more resources towards exports than other things, right? Why is that? Why is that the problem? Like, the fundamental problem really takes you to the market, the way market mechanism is structured in Pakistan, or whether there is a market mechanism to start with at all or not. Generally, what happens is for the countries where this tariff liberalization has actually worked or delivered, for them, what is really happening is their market mechanism or the market system is working at a certain degree of efficiency in those countries. And then what happens is when you liberalize, essentially resources move from less productive sectors or firms towards more productive sectors and firms because the degree of competition has increased in the economy, right? So this allowing resources to move from firm A or sector A to firm B or sector B, that is really, really the key if you really want to make this tariff liberalization deliver. Now let's come to Pakistan. Why? And then there are papers showing that this is really how it works. And there's also a very nice paper, I don't remember the name, it's pretty recent. And then that paper actually goes on to show that if you don't have the market system working properly, if you are supporting different sectors by giving, let's say, by supporting, by fixing prices, by guaranteeing profits, also, or you're sort of creating these regulatory monopolies at a local level for sugar industry and so on. And you're sort of doing everything you can to keep the existing businesses, existing interest groups or firms intact and alive, and you don't expose them to competition, which is essentially the core channel through which this reallocation is going to happen. Then you actually may end up even worsening the resource allocation in the economy in the worst case scenario. Then tariff liberalization, forget improving stuff, it will actually worsen the resource allocation, or let's call it productivity, or the overall productivity in the economy. So the question we really have to answer is, yes, tariff liberalization, I think, fine, it's a good thing, whatever. So exchange rate do help, I think, as far as business cycle fluctuation is concerned. But then if you really look at the structure of it, it is really about making markets work, right? If we don't have markets working, if we are protecting different businesses for political or other reasons, whatsoever reasons, because we don't want people to get unemployed, fair enough, and we don't want any sort of significant disruption, and we want things to stay more of the same, then most of this stuff is pretty useless. I mean, it's good from the point of view of business cycle management as far as monetary policy or fiscal policy is concerned. But as far as long-term prosperity or productivity growth or diversity and all of those factors are concerned, then none of that is going to happen, and none of that is going to come out of it. And then we're just sort of hoping for something impossible, right? So really at the core of it, you really, which I think Dr. Khadija was also pointing to this, you really have to stop this culture of rent seeking. You have to expose businesses to the possibility that if they don't perform, they will go bust, right? Government is not there to just, or the taxpayers are not there just to bail them out just because they want to stay the way they want to stay, right? So yeah, let me just stop there and not take too much of time. Thank you.
Thank you. Dr. Umar, if you want to say something before we move towards question and answers.
Yeah, thank you very much. I mean, in the first place, very interesting comments have arrived. I really appreciate them. Very interesting insight forwarded by Dr. Ahmed Pirzada as far as the application of the predictions of the first generation models of currency crisis in the case of Pakistan. Well, I have listened to that with great interest, and when I go back, I'm definitely going to analyze those predictions in the case of Pakistan. and why it has to be first generation still in Pakistan and not the second or the third generation models. So thank you for that. Dr. Khadija has made some very interesting observations about the competitiveness and how, and if you recall that in my presentation, actually, I had pointed out to this thing that there are quite a few structural issues. I mean, there is product diversification, there is market diversification, yes, sure, and it is centuries old, as very aptly observed by Mr. Amir Durrani. Yes, I agree with that, but then even in those centuries, I mean, things have not changed. This is also there. I mean, that constant is also there. People, you know, we sometimes use the metaphor that people have reached Mars and we are still, I mean, languishing on Earth or things like that. So people have actually, countries have moved on to this. I mean, the global trade has reshaped basically the global value chains, etc. I mean, where Pakistan is standing. These are all structural issues. And a very pertinent point raised by Dr. Khadija, what our institutions are doing. I mean, if we are a textile so-called experts, do we have any textile institutes in Pakistan? How are our universities doing? I completely agree with her, couldn't agree more with her. And it actually reminds me, last year, about 2 years ago, the former governor of the People's Bank of China, he arrived and he had some very interesting observations about exchange rate. And he said that exchange rate perhaps is not going to win you the final battle as far as mimicking the glory of exports that China has actually achieved in recent years. But it's a full-fledged process. It's the institutions, it's the academia, it's the technical know-how, etc., that is going to actually happen. And definitely we need to focus on that. And at the risk of sounding maybe a bit defensive, but if you look at our reports, previous reports, we have been, trust me, repeating these things many, many times. And we will continue to do so because this is our job. And about savings in Pakistan, Amir Saab, very interesting question, very interesting point that you have raised. Saving in Pakistan, low income countries, marginal, I mean, whatever we earn, we consume with a very youthful population. Again, this is another point that is not. And I will again refer to you that in our previous reports, in not too distant past, I think about a year or a half ago, we actually focused on a special section, dedicated a special section which actually focused on this real estate thing. How real estate, I mean, incentives in real estate and sector is actually undermining, I mean, the returns in real estate, how they are undermining the various other sectors of Pakistan. I mean, what are the structural issues that are actually leading towards that thing? We have also covered with that. But I mean, the enigma that the recent surge in workers' remittances has become, I mean, in the beginning, when the COVID-19 shock struck the World Bank was the first to predict that, of course, there is going to be what you call a long-term scarring. And one of these things that is going to cause this scarring is the depletion in workers' remittances, especially countries like Pakistan, Philippines, Bangladesh, etc., or even Mexico. But now, few months down the line, we do see that that projection is actually not correct, and Pakistan has actually increased its flows of workers' remittances. And now, if you want me to sort of explore a nexus between increased flow of remittances and construction sector incentives. So yeah, as far as the correlation is concerned, maybe I'm sympathetic to that, I mean, if you just look at the cement dispatches, which I just mentioned in my presentation, that they are all-time high right now in Pakistan. And one of the reasons is, of course, a very healthy remittances. I mean, in our rural areas and other areas, people like to construct a house, but also a lot of investment under CPEC is going on. I mean, you have this DI Khan route that is being constructed. A lot of construction things, cement thing is being, I mean, transported towards that thing. But to have it as a cause and effect sort of thing, perhaps we would have to look a little bit more deeper in order to actually set this particular relation. And as far as this pensions things is concerned, sir, let me just share with you that our first quarterly report is going to have a special section on pensions in Pakistan. We are very much alive to this particular issue. And just let me share with you one very good observation that pensions have become, I mean, there are some long-term, as you will find out in our special section, there are some long-term structural issues as far as the framework of government pensions in Pakistan is concerned, which actually have been exasperated in the last 10 years and have become, and their sustainability has become a big question going forward. I mean, there have been some ad hoc measures and some other things that I will like you people to go through it once it is out. It is going to be out very soon, hopefully before this year ends. So we have actually tackled this thing and tackled things in most objective way as possible. There are many things, of course, we have appreciated all the policies that the government has actually undertaken in FY20. And I mean, they have shown results also. I mean, if I am not wrong, they have also shown results. But that we have very openly said this thing that these things could, I mean, their sustainability could be very vulnerable if you are not going to undertake such long-standing structural issues in the Pakistan economy. So this is something that I wanted to just say this thing. And rebasing of GDP is also coming. Amir Saab, this is also very much on our radar. We are going to talk about this thing. I mean, when State Bank has to publish something, it has to be very, very careful that we have everything which is fully supported by data. And that many times, I mean, we are not at the liberty of saying things as freely as freelance economists sometimes might say that. So we really need to have a lot of data and we have to be very sure what we say before it comes out. So, but thank you. I have actually jotted down all the points that you have given, and with the hope that in our forthcoming publications, we are going to touch this thing. And this I promise we are going to touch definitely. They are very, very interesting points. Thank you.
Thank you, Dr. Umar. Mr. Amir, you wanted to share some
Yeah,
thoughts?
thank you. I just wanted to, I mean, I wanted to re-stress before the Q&A session starts what Khadija has said. I think, Khadija, I missed this point. Actually, I was looking at my notes. I had this, that, relief packages basically enhance inefficiencies in an already inefficient private sector. And basically, my example has been, I have been very closely watching the aviation industry in US, and having spent 8 years there in my youth. I mean, I think that, you remember there used to be a time in the last century when you would get bailouts for airlines and aviation industries. And I was kind of hoping that both the two large airlines there would get this bailout package this time. But despite Trumpian economics, there was no such bailout. There was no fiscal incentive given. In fact, if you now see yes, there were some financial on the what you call monetary supports, and there was some rescheduling of debt because that industry runs on leasing, insurance, and financial products. So because of that connectivity, you now see that the most innovative airline is actually the one that's coming out more successfully. And despite and this the reason to watch the aviation industry in the US, because post Pan Am, this is half the world's air miles, seat miles are flown in the US even today. And so the COVID hit on US alone, if you look at 350 million people, you will, this is a study. So that for me is very important what you just said. And I want everyone to understand that. And the second point, it relates to this whole thing, which I think Ahmed said very rightly. And Ahmed, that was my point, that we do not have markets that are functioning. Therefore, a lot of stuff we talk about is really us doing sort of mental exercises, if I may politely say that, as to what actually may be happening on the ground. And I think the last thing I wanted to on the comments is that by the way, I also forgot, Dr. Umar, that if you look at, and you will see this in Q3 this year also, the PSTP spending rate and actually the actual implementation is 70%. This is the number I got from from Saim Ali yesterday from Ministry of Finance. So again, these are temporary boosters, right? Correct. But that's why I also want to be very sure that we kind of are not relying just on World Bank and the fund and those numbers, but actually looking forward, maybe doing, instead of doing a post 5-year average, we want to do a forward-looking 5-year average of what Pakistan's economy could be doing or what could be happening. So I think that I'll stop at that. Thank you. But thanks for all the clarifications.
Thank you so much. Now I'm opening the floor for question and answers. First up, we have a question from Mr. Noman Mahmood. And sir, can you please unmute yourself and ask the question? Mr. Noman Mahmood. Okay.
I think he's not there. So please, Rabia, move
Okay.
ahead.
Let me ask Sayyid Murtaza Nadeem if you want to ask the question.
Assalamu alaikum, sir. My name is Murza, and I'm currently a master's student at IBA. And this was a very informative session for all of the students. And my question is related to the recent phenomenon of the increase in the currency in circulation, which so not only acts as a drag on liquidity, but also impacts the credit multiplier in the economy and also on lending at a broader scale. So, what are your views as to why this currency in circulation has increased in Pakistan, and what can be the role played by State Bank to bring it down, or at least bring it near to the regional peers such as India, Bangladesh, and Sri Lanka? So, what are your views on this? This is my question.
So, Murtaza, thank you very much for the question. This is a very pertinent question. And if you, again, I would refer you to our reports. We have been dealing with this question repeatedly for the last 2 years or something. But in a nutshell, just very quickly, I would just tell you that it actually really came into the forefront when we had imposed this withholding tax in 2015. And since then, actually, it has been climbing up and up. And the recent surge, the reason behind the recent surge is the COVID-19. When the COVID-19 shock struck, there was a lot of uncertainty, and we saw a very serious spike in this currency in circulation. Now that it has gone slightly down, but it is still very much high compared to, as you have just said, the peers. So for this, we are actually taking measures as far as deposit mobilization things are concerned. So hopefully going forward, this is going to be overcome with the best of.
Okay, thank you.
Anyone else? If anyone has a question, please use the raise hand option. Yes, we have Muhammad Imran Khan.
Assalamu alaikum. Hello.
Ji, we can hear you,
Assalamu alaikum.
please. Walaikum salam.
Thank you. Sir, I'm Mohammad Imran Khan. I have received environmental economics degree from PAID, Pakistan Institute of Development Economics. Sir, my question is related to the phenomena of inflation in unemployment occurring at the same time in this situation of COVID-19. So what exactly SBP or other institutes working on the enhancement of economic growth of Pakistan are responding to this situation? Because on one side, if we want to improve the situation on inflation side, so there it stretch out to the unemployment. If we want to reduce the unemployment and there
Sorry,
is a
Imran, can
tendency.
you please say a little louder? Because I think we cannot hear you.
My question is about inflation and unemployment situation, which is occurring at the same time in the Pakistan economy during COVID-19. Because if we, this is the dilemma, if we want to reduce the inflation rate, there is a tendency that the unemployment will increase. If we increase the unemployment, there is a tendency that inflation will increase. So what exactly SBP is practically doing as a response or other institutions are responding to this situation during the COVID-19? Thank you very much.
So, would you like to respond, or should I take another question before you respond?
Please take another question.
Bilal Makbul. Yes, please, sir. You are next. Yes, Mr. Bilal Makbul, if you have a question, please unmute yourself. Okay.
Rabia, okay,
Saad
in the
Ahmed.
interest of time, this must be the last question.
Okay. So this will be the last question. Saad Ahmed, if you would like to ask.
Okay, yeah. So basically, my question is that the state bank has done a really good job in terms of demand compression, and that was done in the very first few months of the new authority coming in. So that's not a huge problem. The problem is the supply side. So just to give you an example, in our textile sector, most mills are already at 100% operating ratio, and not much expansion can come from there in the short term, and rather the long term is needed on that side. So what more is being done on the supply side to improve that sector? Thank you.
Thank you. Whoever from the panelists or anyone who want to answer that? Yes, Dr. Omar Saqib, if you want to reply to that.
Okay, in the first question about a very classic textbook question about stagflation. So when you have a supply side shock, what should a central bank do? I mean, when there is a supply side shock, usually a central bank is helpless. So if you look at the aggregate demand and aggregate supply curve, so the supply curve shifts upward, that actually causes not only output contraction, but also higher level of inflation. But inflation fighting central bank, what he or inflation fighting central bank usually will go for curbing inflation. So in this particular respect, you have seen that although there have been quite a few shocks in the Pakistan economy recently, as I was mentioning in my presentation as well, the non-food, non-energy, the underlying inflationary pressures that in Pakistan, they are somehow stabilized. I mean, starting right from the previous year, that is FY20 and well into FY21. And that is one of the, that or policies were, inflation expectations have been rather well anchored as a result of State Bank of Pakistan's. And as far as the getting out of the unemployment, you have seen quite a few policies from the government, which it has undertaken. I mean, I had hinted to you earlier that not only government has been supporting by doling out cash, but State Bank of Pakistan has also has launched quite a few refinance schemes in order for unemployment, to check the unemployment. It has been giving easy credits to firms and companies throughout Pakistan so that they can retain their employees even though their businesses are affected by this particular shock. And the second point was from Saad. I actually couldn't get what he was saying.
Okay, so shall I repeat? Okay, so basically what I'm trying to say is that in overall demand compression has worked very well from the state bank. That has worked, the policies have worked very well on that front. Inflation now is being caused by the supply side issues. So in terms of expansion not going on, so just to give you an example, textile mills are currently at 100% operating ratio. So yarn production and cotton cloth production can't go much higher than this. Exports can't grow very fast in the short run. So in the short run, what is being planned? In the long run, the current policies will work well, but what is the plan for the short run?
Okay, Saad, actually, you see, if you look at the current inflationary, it is more from the food or, the food side. and that has been the supply. The source of, I mean, if you typically focus on the sources of inflation in a developing economy like Pakistan, so it is mostly going to be the cost shocks, it is going to be the fiscal view, right? And it is going to be the inflation inertia. So as far as the current inflationary challenges are concerned, as I've just said to you, that or inflationary, the fiscal view is not there very much because there is zero government borrowing from the central bank. So you close that lip, right? Then you come to the output gap, as you have seen, that the economy the output gap is still negative in Pakistan. So I mean, as the economy expands, it is going to be not going to be inflationary. And as far as the cost shocks are concerned, I had mentioned this thing, that one of the reasons that why this inflation is at an elevated level, it is because of the cost shocks. I mean, we have seen quite a few problems in the food market in Pakistan as far as the wheat sector is concerned. Perishable items are concerned. So these shocks have actually caused a hike in inflation in recent times, and not because of these consumer goods that you are actually referring to, like textiles sector.
So let me comment on this question as well, so I can be a bit more brutally honest. So I think on the supply side, there's nothing interesting happening. There's nothing to celebrate as such, to be honest. And the reason is because, so one thing you should be, so there are obviously global shocks, right? So like Amir was saying before, that the global food prices have gone up, and therefore there's so much that the government can do about that, fine. But then again, so the government hasn't made life easier either. So you've got import restrictions. Every other few weeks, you have to go to the cabinet to get permission for quotas and all those things. And essentially what that does is, fine, you have a cost shock, government can't be blamed for this. But then all of these restrictions and quotas and all of these mechanisms in place, they sort of amplify the effect of the shock. Something which should have been resolved rather 1 month before or 2 months before, that ends up taking much longer before it gets resolved. The second thing, this is sort of more relevant to what Imran was saying. What Saad was saying about the supply side. On the supply side, remember, so in a market economy, which we pretend to be rather quite excellently, what really happens is that you need to allow prices to change, or relative prices to change. It's only then that the businesses will end up expanding or contracting in response to the demands of the economy or the requirements of the economy. And then that's something which we don't allow, which we never allow, which we don't even want, probably as a society. And that sort of goes back to the discussions which we were having before with Amir and Dr. Khadija, which is, you've got these guarantees, you've got fixed prices, you've got fixed, let's say in the oil supply chain, you've got fixed margins, you've got regulatory monopolies, you've got import restrictions. There's everything the government does in its power to make sure that businesses stay the way they are. Okay, precisely. And if that's the case, if that's the thing you are going to stick with, then nothing interesting is going to happen on the supply side. All you're left with is a static economy. And then the only thing you have to solve for is essentially demand management, right? Which is what the central bank's job is. Central bank's job is not to alter the structure of the economy, because they don't have the tools to alter the structure of the economy. So unfortunately, on the supply side, the performance is pretty dull, or rather disappointing.
Okay, thank you.
Sorry.
There is one thing that I just would like to say here. I mean, in response to this COVID-19 shock, I mean, of course, the food prices are rising. Actually, I wanted to comment on it earlier when Amir Saab was saying this thing. COVID-19 shock has actually impacted the agriculture sector in Pakistan a little bit as well. I mean, we were in the beginning claiming that nothing has happened to the agriculture sector and the performance has been right. But when we look at the inflation data of the first quarter of FY21, so we see quite a bit of a hike in the tomatoes and potatoes prices. And if you go back to the rural areas and try to connect that what was going on, so you will come to know that farmers actually did face supply side issues as far as the sowing of tomatoes and potatoes is concerned, right? And as I mentioned you earlier, that in one of our staff notes, SBP staff notes, we have highlighted this particular problem. That, for example, as far as the imports is concerned, or restrictions on the border are as such that does not, I mean, the timely imports of tomatoes, you remember, not too distant past, we had this tomato crisis in Pakistan, and we were not able to import tomatoes in time. And that is one of the reasons that what Ahmed has actually highlighted right now, that there are certain barriers of sanitization, etc., that did not allow the timely. And we actually were not there in well within time to actually address those things. So these are some structural issues that actually sometimes exacerbate these cost shocks that we see.
So, Dorsa, thank you very much. And Adnan and Rabia, I have to go to my Uzbek meeting, but I want to make two quick points, if you allow me, just 1 minute. Basically, unemployment, and I want to go back to that question, unemployment that I forget which gentleman was asking. But to be very honest, because of the construction sector, the sort of the measures that were announced, etc., you do find that unskilled labor was not unemployed. So basically, at the real bottom tier of the employment, if you look at that, it's working fine. Where there is a gap, and this is what has happened. Look, in a situation where mobility is restrained, in a situation where production is restrained, where interaction is restrained, and which is what's happening in COVID. What will you do? I'll give you an example of firms like us, which are kind of, you can say, intellectual services firms, but also kind of, we also have an interest in energy production. So bottom line, what is happening is that then you start getting efficiencies out of the people who produce most. So basically, this then becomes a game of productivity. So yes, a lot of skilled, and within skilled, both on the vocational side, which I find a misnomer, but I'm going to use it. So on the vocational side, and also on the side of what I call graduates. So basically, higher HEC, what I call 16-year plus education graduates, are facing a serious problem. But that problem, I think, has less to do with COVID than to do with the skills that are being imparted in the universities. Because I can tell you personally, I have interviewed almost 600 people over the course of last 4 weeks. And I can tell you that I found 2 people worthy of taking to a second interview. These are graduates from NAST, LAMS, ICRA, Amdar, you name it, and PIDE and QAU. So I think I want this person who ever asked this about employment is look inside and first decide what are the skills we are imparting before we take up this question of how much employment is the government able to generate. Government, what it had to do, they did it. Construction sector stayed open. The PSTP spending went up. So basically, those people related to that got employed. And I think this point it should not be taken lightly. What Ahmad has said and Dr. Saab also said. There is a phase angle in markets, especially related to food, which should not be here in Pakistan. In fact, we are trying to be protective. We are trying to have some sort of halo that the government is the sole protector of the common man. Actually, it's creating more problems because, as Ahmed said, this whole crisis on food will never happen if things were open, if there were real markets functioning. Because end of the day, by the time the government decides to take a decision, which is like a committee which created a camel, the crisis has already hit the head. Yeah. So, anyways, I think Nan and Rabia, Ahmed Saab, Dr. Umar, and Khadija, thank you, and all the audience. I have to run. But this has been a great, great webinar for me and learning from you. Thank you, Adnan.
Same here. Thank you. Take care.
Thank you so much, sir. And due to shortage of time, we won't be able to take more questions. So let me just thank all the participants for being here. And I would also like to thank